Lecture 14, Examples of Trading Channels. In this lecture, I will show you several examples on how you can successfully trade setups based on channels. To trade channels successfully, you need to be familiar with trading special type of channels called flags. Flags are very common price action patterns which you can see in every chart every day. In this chart, for example, the down channel here is actually a flag, and precisely it is a pull flag. A flag actually is a small trending channel in opposite direction to the main trend. So it is considered a pullback from the main trend. It could be a deep or a shallow pullback that are formed by the market mainly to keep with the trend traders out of their trades and to trap counter trend traders in the wrong direction because they trade these flags as a reversal signal, when actually those flags often represent a continuation signal. The name of the flags is somehow confusing. Downtrending channels just after a strong uptrend is called bull flag, while on the other hand, bear flags are uptrending channels after a strong bear trend. Depending on this basic classification, the flag that you are seeing in this chart is a bull flag because it is trending down after a strong uptrend, and it should be traded as a continuation signal where the price is expected to break the channel resistance line to the upside. Because flags are confusing, I will explain it again. As you have seen, flag is a type of channels which is a trending channel in the opposite direction of the main trend that is preceding it. It doesn't matter if it's a triangle or a parallel channel. A bull flag is a downtrending channel, I mean a bear channel, which comes just after a bull trend, while a bear flag is bull channel, which comes just after a bear trend. This is another example of a bull flag that is formed as a triangle. It is a downtrending triangle that came after a strong uptrend. Therefore, it acts as a bull flag and signals a trend continuation. As you see here, the price as expected broke to the upside, and the main trend that was before the bull flag has resumed. As you see in this chart, the price was in a strong downtrend. Then the price paused in this area and formed an uptrend triangular channel, which is considered a bear flag. Then the price broke this uptrending channel to the downside to resume the downtrend. Flags similar to the one presented here and in the previous examples are usually trend continuation patterns. For example, when there is an uptrend, a bear channel is considered a bull flag, and often, but not always of course, the price breaks through the upper line of the channel and the uptrend continues to a higher high. When there is a downtrend, a bull channel like this one is commonly considered a bear flag, and often the price will break the lower line of the channel, and then the downtrend continues to a lower low similar to what it happened here. While many technical textbooks gives bias classification for every type of channel as bearish or bullish setups, I always recommend to treat channels as trading range, where it is risky to sell just below the lower line or to buy just above the resistance line because of the magnetic power of the center of the channel, and because most of the time breakouts through channel lines fail, trapping traders in the wrong direction. However, what I recommend is to buy near the support line of the channel and to sell near the resistance line, but only with the direction of the trending channels. That's it. I want you to differentiate between trading channels price action from trading channels breakouts. But how about trading flags, which are continuation signals with breakout expected to be opposite to the direction of the channel itself. When you are dealing with flags, the signal for the breakout must be very strong because you are trading against the direction of the channel and because you are buying above the resistance or selling below the support. And these two actions are very risky. Conservative traders need to wait for a pullback to the trend line after the breakout before entering the market, and then assess the reaction of the market to these pullbacks as a confirmation that the breakout will be successful. This chart is showing a bear flag represented by this uptrending triangular channel. And because the trend preceding this bear flag was a downtrend, the flag is expected to be broken to the downside. But before the real breakout, the market is expected to trick traders with failed breakouts, like these failed breakouts. The real breakout came as expected to the downside and was expressed by strong bear trend bar, where the entry for your short trade could be safely bought here when the price, after a rejected pullback, goes below the signal bar to protect you from a failed breakout. This will give you higher success percentage and will help you to avoid being trapped. When trading channel, first profit target need to be a measured move that is usually equals to the height of the channel. Consider this example of showing a price consolidation inside a horizontal channel. When the channel is broken here, normally the first profit target equals the height of this channel, which is calculated here. The first profit target can then be projected to the upside here. Of course, the price can move further beyond the first target if the new formed trend is strong enough. All of these details about channels seem to be complex and somehow confusing. However, trading channels is simpler than it looks. Most of the time, the channels are treated like a trading ranges, where the price is showing consolidation before the breakout. It doesn't matter much what type of channel is. As long as the channel lines are not broken, the price will continue going sideways. And when the channel is clearly broken, ride the breakout at least to a measured profit target and maybe beyond if the momentum is strong. This is the end of this lecture and the end of the second section. In the next section, you will learn about trading ranges, their characteristics, and how they can be traded successfully.